Now that Mad Cleaning has determined all the revenues it expects to generate during the period in its sales budget, all of the inventoriable costs it expects to incur via its direct materials, direct labor, manufacturing overhead, and cost of goods sold budgets, and all of the non-inventoriable costs they expect to pay during the month of January 20XX via their S&A budget, they have all the information they need to figure out what amount of operating income they expect to generate by producing this level of units, this number of bottles of all-purpose cleaner, and doing so at a certain price and selling them at a certain price. So in all of our sub-budgets, the budgets we've made before, we have all the information prepared already to make our budgeted income statement at least up until operating income. And the first thing, like any income statement that we need to start with, is our amount of sales revenue. Well, we made a budget for that. If we go back to our sales budget, we see that their total monthly sales revenue is expected to be $80,000. So if we go to our budgeted income statement for sales revenue, we can just go and take that $80,000 right from our sales budget and throw it into our budgeted income statement. Obviously, we're not going to get to keep that $80,000 because we have to pay to produce goods and we have to pay all of our other various costs. So we need to figure out, firstly, what amount of that $80,000 is going to have to go towards covering our cost of production or our cost of goods sold. We made a budget for that. According to our cost of goods sold, our expected monthly cost of goods sold to be recorded is $63,000. So we can go back to our budgeted income statement and take that $63,000 right from our cost of goods sold budget in order to determine what our gross profit is on our budgeted income statement. And gross profit is simply sales revenue less cost of goods sold. So if we're doing $80,000 in sales revenue and it's costing us $63,000 to produce those bottles of all-purpose cleaner, which we're turning around and selling, that means that our profit purely from the markup that we're selling these bottles for above their cost to produce is $17,000. And then we have our selling and administrative expenses, all the costs that we're going to incur, which we cannot inventory. Well, we made a budget for that. On our S&A budget, we see that Mad Cleaning is expecting to incur $3,000 worth of non-inventoriable selling and administrative costs during the period. So we can go and we can take that number from our S&A budget of $3,000. And for our operating income, well, that's just gross profit minus all of your period costs, all of your selling and administrative costs. So if we have $17,000 that we're making purely from markup on the goods that we are producing and then selling, and then another $3,000 worth of costs that we have to pay besides the cost to produce those goods, that means at the end we're going to have $14,000 worth of operating income left over at the end of the period. And we can go back all the way to the beginning to when we did our CVP analysis to see if we're meeting our desired level of income. And if we go all the way back to the very first step that we had on CVP, we said that our target monthly operating income for January of 20XX was $14,000. Well, we just proved that on our budgeted income statement.